The Bank of Canada increased interest rates by 1/4 point today and boosted its inflation outlook, which means potentially higher rates. We're going to talk about that after the intro. The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. All right, so as expected, the Bank of Canada increased their key overnight lending rate today to 0.5%. That's an increase of 1/4 of a percentage point, so 0.25%. This was widely expected. It was very much something that everyone saw coming. There was some expectation that it might increase by 0.5%, but with what's going on in Ukraine right now, that was obviously something that just was taken off the table in the last week or so. So we're going to discuss pretty much everything with respect to the interest rate increase, and specifically with respect to the Bank of Canada increasing its inflation outlook, given what's happening overseas. I'm going to talk about all the details and what it means for you and your mortgage. But before we get into it, do me that favor, hit that subscribe button and that notification bell, and please hit the like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. We're about 2,500 subscribers away, so we're getting there very, very, very quickly. And we're going to give away $5,000 to one lucky subscriber, but in order to win, you have to be subscribed. And one last thing before we get into the video, this is interest rate week at Mortgage 360, and that means that our Secrets to Getting the Lowest Interest Rate course is on sale for just $47. Gives you all the information you need to negotiate with your bank, your broker, to know exactly how much margin is in it, and most importantly, is to make sure you are aware of all the landmines and the surprises that could come along with just asking for the lowest interest rate, because it's like anything else in life, you get what you pay for. So that course again is on sale for $47 until March 7th. After that, the sale goes away. There will be no do-overs. It will not go down in price ever again. And if you want to get a hold of that course, just go to ratesecrets.ca or go to the link in the description below. So let's get into it. Let's discuss everything interest rates, Bank of Canada interest rates. Very much, like I said, widely expected that the interest rate was going to increase. So what this means for you is if you have a variable rate mortgage or you have a home equity line of credit, your interest rate likely increased by 0.25% today. Actually, more accurately, it'll probably increase by 0.25% starting at the beginning of next month. And that is essentially this. So this is how it plays out. This is the breakdown of what it means to most people. If you have an adjustable rate mortgage, your payment is likely to increase by about $12 per month for every $100,000 in mortgage that you have. If you have a variable rate mortgage, your payment is not likely to increase, but the amount of interest that you will be paying every month will go up by about $21. And same for if you have a home equity line of credit, you will be paying about $21 more in interest every single month. And therefore, you'll likely have about a $21 a month higher payment. And again, that's for every $100,000 in mortgage or line of credit that you have. Now, the big thing here is that the Bank of Canada started talking about the inflation outlook and how it's boosting their inflation outlook. So I want to take you through the actual report from the Bank of Canada and show you exactly what they said and what they're talking about and why this is so important. So we're going to start first and foremost. This is from the very first paragraph. The Bank of Canada today increased its target overnight rate to 0.5%, and the bank is continuing its reinvestment phase, keeping its overall holdings of Government of Canada bonds on its balance sheet roughly consistent until such time as it becomes appropriate to allow the size of its balance sheet to decline. So here's what this means is, one, they've increased interest rates, but they're keeping the amount of bonds that they have on their balance sheet roughly the same. So what does this all mean? Well, what it means is that they have two tools in play here. They have interest rates and they have bond holdings. So in the event that they started to decrease their bond holdings, it would essentially have a similar impact to raising interest rates. The reason why is because they would no longer be buying bonds. That therefore would mean that there would be less demand for bonds, which means the prices would go down and yields would go up, which would mean that overall interest rates, both for fixed and variable rates, would start to increase with less demand for bonds. So they have both of these tools at their disposal. And what that means is that they can increase interest rates, but they can also use some of the more quantitative measures to also have an effect on the economy should they deem it necessary to do so at any point in time. So it doesn't necessarily mean that the only way to deal with inflation is rising interest rates, but they have two tools here that they can deal with. Now, they did also discuss in the second paragraph of the report the unprovoked invasion of Ukraine by Russia, and that this is a new source of uncertainty. And it's very clear that this is going to have an added impact on inflation or upward pressure on inflation. The reason why is because things like commodity prices for things like grains are going up, things like energy prices are going up, and so on and so forth. And as a result, that's going to have an impact or an upward pressure on inflation. Now, it's going to take some time to figure out how much of an impact that is going to have, but they are definitely looking at this and going, okay, that will have an effect on what we do in the future, and it could very well have an effect on Canada's inflation rate. And they point out very clearly that they are following the events of this closely. Now, economic growth in Canada for the fourth quarter was higher than expected at 6.7%. This is stronger than what the bank projected, and I think what anybody expected. Obviously, leading up to the Christmas season there, we saw a lot of people out spending, a lot of people doing the things that they would normally do in a normal economy, especially with inflation where it's at, and people basically spending more money on goods while they had the chance to buy them cheaply. So that added bit of growth also indicates that the slack in the economy has pretty much been taken care of, and that the Bank of Canada can start moving towards a more normalized interest rate policy. Now, here's where it gets really interesting. CPI inflation is currently at 5.1%. This was expected for January, remains well above the bank's targets. Price increases have become more pervasive. We've seen this either in the grocery aisle or when you're buying different goods and services and so on and so forth. Frito-Lay's, for example, asked Loblaws if they could raise the price of Doritos, and obviously Loblaws said hell no, and you're seeing less and less chips in the Loblaws aisles right now as a result of this. And in addition to that, poor harvest, higher transportation costs, this is all leading to higher inflation. And they're expecting that this is going to be higher in the near term and for the long term as well. It's going to have an impact on the long run inflation targets. And the bank has made this really clear, and where I think it is very important to pay attention here is that they say very clearly the bank will use its monetary policy tools to return inflation to 2% target and keep inflation expectations well anchored. So in other words, they're going to do something about this problem, whether it is not buying back bonds or whether it is increasing interest rates, and they are paying attention to it. And we have started that process of them taking care of this inflation issue. Now, the policy rate is the bank's primary monetary policy instrument. This is very important because it's very clear. They are saying that interest rates will be first and foremost the tool that they use to get inflation back to where it should be. And they are going to look at that 2% target. So the reality of it is this, is we are starting to see the interest rates increase. We are going to see them increase probably consistently over the next few months. The markets are telling us that we can expect to see about 1.5% in interest rate increases over the next 2 years, which means the target rate where your mortgage is likely going to be at if you have a variable rate mortgage is about 3%. Now, where are fixed rates right now? Well, 5-year fixed rate mortgages are at about 3%. So what that means is that if you are running a variable rate mortgage at this moment, you have about 6 interest rate increases where you will still be saving money if you choose to keep your variable rate mortgage. And what that means is that those 6 interest rate increases that could potentially happen, if they happen, the period of time between now and then is going to be a period of time where you are saving. And then once you get to the point where interest rates are at 3% or variable rates are at 3%, well, then you're going to need several interest rate increases after that to cancel out all the time that you've been saving. So for most people, the reality of it is this, is if they do the calculation and they go in and they take a look at their payment today on a variable rate and they look at their payment of what it would be at 3%, well, they're going to go, okay, I've got a pretty significant amount of savings that I can have between now and when variable rates get to 3%. So they're going to stick with their variable rate strategy. And same for new borrowers. They're probably going to look at this and go, well, I've still got some time to save money. And in the event that that fixed rate and that variable rate get close together, let's say fixed rates come down and variable rates come up, well, then it might start to make sense to look at fixed rates over variable rates. But until that time, variable rates seems to be the play that most people are choosing right now. Now, people go, well, I'm worried about my payment going up. And what happens if it goes up more than that? I need to be fixed. And, it's the thing I need to do. And that's the thing that makes the most sense to me because I'm worried about interest rates going up. Well, let me present the problem to you. And this is why I tend to recommend adjustable rates over variable rates and fixed rates for that matter. And that's because let's say you do get a 5-year fixed rate right now. And let's say interest rates do go up. Well, guess what? You're not getting rid of the problem of rising interest rates. You're just delaying it further down the road. And you're also giving up your opportunity to save while interest rates are going up before they get to that 3% level. So in my mind, and in most of our clients' minds, when they look at the numbers and they look at the data and they look at the difference in payments, it's clear that the variable rate strategy is still a good strategy until such time as we get to where those variable and fixed rates are very much close together. So, that's what happened with the Bank of Canada today. We saw a 0.25% interest rate increase. We saw them boost their inflation expectations. We're going to see more from them tomorrow when they start talking about interest rates and they start talking about their policy decisions in a scheduled speech. And we're going to see more on April 13th, which is the next scheduled meeting date for the Bank of Canada. Probably going to see another 25 basis point hike then, although that's more than a month away. A lot can happen in a month. We'll only know at that point in time how much interest rates are actually going to go up, or if they're going to go up at all. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about our race to 25,000 subscribers and that ratesecrets.ca course, and we'll see you on the very next video. Cheers.